All right, hello, this is Mike with the NetPicks Inner Circle. In this week's Trade of the Week, we're going to take a look at selling a call spread on Facebook. Let's start out by taking a look at a chart to show you the premise for this trade. Over the past week and a half, Facebook has made a pretty impressive run to the upside. Back in late January, early February, we saw a pretty nasty move to the downside. You can see it there on the daily chart. We came down and we tested the 200 period moving averages. We found some support there, and we've basically moved straight to the upside over the past week and a half. We've moved from 167.5 all the way up to around 182. That's a heck of a run on Facebook. We are now approaching some areas of resistance, and it's my outlook that Facebook is going to get a little tired here in the near term. Doesn't mean Facebook can't move higher the rest of the year. I just think in the near term, we're due for a pause. Or even better, a pullback. If we roll back over to the downside, I want to be positioned for that. If I were just to come in and buy a long put here, the problem with that approach is the only way I make money on that trade is if Facebook makes a big move to the downside immediately. I'm not convinced that that's going to happen. It may take a couple of days. Facebook may chop sideways for a few days. We may even hand a little higher from here before we roll over to the downside. So we're looking at selling a call spread here instead. And let's go ahead and go over to the trade page to piece this trade together. First thing I will point out, down in the statistics, down towards the bottom of the trade page, you will see that the IV percentile is at 55. The reason that's piquing my interest, the IV percentile tool is taking a look at the past year worth of price action on Facebook and the last year worth of volatility levels. And it's telling us the 52-week high, the 52-week low, and then plotting in the current level of implied volatility being used to price the options. With an IV percentile at 55, we know that the volatility is near the higher end of where we've been over the past year. When that happens, I know that the options are more expensive, there's more premium to collect, and that allows us to push our break-even point farther away from the current stock price. I'll talk about why that's crucial here in just a second. So anytime the IV percentile is above 50, that is the market's way of giving me the green light to sell premium. In this case, we're selling a call spread. Now, I went out into the March monthly options. They have 21 days left to expiration. And remember, I want to lean bearish here, so I'm looking to sell a call spread. By selling the call spread, it just gives me multiple ways of making money on the trade. And we'll cover that here in just a second. So what I did is I came in and I looked to sell the 185, 190 call spread. What I'm doing here is selling the 185 call, and then I'm also buying the 190 call at the same time. That puts me in a risk-defined trade where I'm collecting $1.43 or $143 per contract to put on this trade. Notice I'm selling the out-of-the-money call. I'm selling a junky out-of-the-money call that has a very low probability of success. That's exactly what I want because I want this spread to go to zero as soon as possible. The cheaper those options get, the more money I can make quickly. All right, so by collecting $1.43, let's go ahead and bring up the order confirmation box. The $143 is the most money I can make on the trade. So regardless of what happens on Facebook, if it makes a $50 move to the downside, the most I can make is $143. The reason I like that, the reason I'm willing to give up my unlimited profit potential, is look at the risk side of things. Okay, I'm risking $357 per spread. It's a $180 stock. It's a pretty expensive stock. I'm controlling 100 shares of Facebook stock for under $400 by utilizing the short call spread. My risk reward scenario here, I'm risking right between 2 and 3 to make 1. I'm willing to accept that ratio because I have 5 ways of making money on the trade. My break-even point is at 186.43. That's calculated by taking my short strike, which is the 185 call. I'm adding in the $1.43 that I'm collecting to put the trade on. So my break-even point, again, 186.43. I don't care if Facebook moves higher, lower, or sideways. As long as it stays below that number, I can make money on the trade. I also make money if time decay adds up. I make money if volatility decreases. So every day that I hold this trade, if I buy a long put, that time decay is working against me. Every day that I hold that trade, it's losing some value just due to the time decay. By selling the call spread, every day that I hold the trade, the time decay is working for me. That takes a lot of the pressure off the timing of the trade. If it doesn't move to the downside immediately, I'm okay. If it moves sideways in here for the next week, I'm okay. I can make money from that type of movement. I mentioned that the IV percentile was at 55. That's a pretty high level. So if volatility contracts, which over time it should, Overtime volatility likes to gravitate back down towards the 50th percentile. So because it's above that level now, I'm expecting it to drop over the coming weeks. If that happens, I can also make money from that type of scenario. So I have 5 different ways of making money on the trade. The reason I love these types of positions, it takes a lot of the pressure off needing everything to line up perfectly in my favor to make money. Does it give me the home run profit potential? No. If I had a stronger outlook on Facebook, if I was expecting a bigger move immediately, buying a long put here is going to give me a larger profit potential, but that's not my outlook right now. I'm a little less certain. I'm expecting a little bit of a choppy stretch here, a little bit of a consolidation on Facebook. So this allows me to stay active, generate some income, and I have 5 different ways of making money on the trade. So it puts the odds and the probabilities in our favor long term. So now we'll just track it. We get the trade on here today. We can track it over the next 21 days. It's not something I have to come in 2-3 times a day to check the trade. I can just come in, take a look. If price action is below 186.43, I'm fine. Even if it stays below that level by 1 penny, I'm fine. I can make money on the trade. So it's a very, very easy trade to manage. We are targeting 50 to 75% of whatever we collect for this trade. So if I can come in and buy this thing back over the next couple of weeks for 35 to 70 cents, that's exactly what I will do. It'll give me a really nice profit. I'll free up the capital and move on to the next trade. All right, so we will keep you posted here over the next couple of weeks and how we manage this position. The whole idea of these trade of the weeks is to give you a feel for how we approach the markets at NetPicks and give you a feel for how these trades can be utilized in different types of market conditions. So I'm going to go ahead and wrap this video up here. If you have any questions, feel free to contact us directly. My direct email is mike@netpicks.com. All right, we'll be back with you guys next week for our next trade of the week.